You know, in trading, there's one thing that matters way more than picking the perfect stock or timing the market just right. It's all about survival. So today, we're going to break down the absolute essential rules that keep you in the game, protecting your capital so you can live to trade another day.
I mean, it's the question everyone asks, right? Is there some secret indicator, some, hidden piece of knowledge? Well, the truth is, it's something way more fundamental, and it has absolutely nothing to do with predicting the future.
The answer? It's discipline. It's a system, a set of rules that takes the really destructive emotions like fear and greed completely out of the equation. And this system, it's your single greatest defense against a catastrophic loss.
Okay, so where do we even start with this defense? Well, it all begins with one single powerful rule that acts like a shield on every single trade you make. Honestly, just mastering this one concept will put you miles ahead of most traders out there. This right here, this is the number that needs to become your mantra, 1%. The rule is just this simple. You never, ever risk more than 1% of your total trading capital on any single trade. And listen, don't think of it as a suggestion. It's the absolute bedrock of your survival.
So what does this actually mean? It means that no single trade, no matter how confident you are, has the power to just knock you out of the game. And the psychological freedom that gives you is it's immense. When the absolute worst thing that can happen is a tiny, manageable loss, you can start making clear, rational decisions instead of trading from a place of fear. Let's make this really concrete. Say you're trading with a 2 lakh rupee account. That means your maximum risk on any one trade is capped at just 2,000 rupees. That's it. This simple calculation is your insurance policy. It literally guarantees that even a long string of bad luck won't wipe you out. Okay, so the 1% rule is our North Star, our guiding principle. But how do we actually apply it in the real world, when the market is moving? Well, the next crucial step is turning that risk percentage into a specific position size for every single trade. This formula, this is your toolkit. This is how you turn that theory into practice. It's so clever because it connects your maximum risk, that 2,000 rupees we just talked about, with the specific details of the trade itself, like the distance between your entry price and your stop loss. This is how you take control of risk before you even put a single rupee on the line. And it doesn't matter if you're buying long or selling short. The core logic is exactly the same. The only thing that flips is a tiny little tweak in the calculation, just to make sure the distance to your stop loss is always a positive number. It's a small detail, but it keeps the math consistent and reliable every single time. Now here is a critical piece of discipline in action. Let's say your formula tells you to buy 107 shares, right? You don't buy 107. You buy 100. You never round up. The unbreakable rule is to always err on the side of caution. You risk a little less, never a little more. So you've totally mastered how to protect each individual trade. That's great, but a whole bunch of perfectly protected trades can still sink your account if you're not looking at the bigger picture. So let's zoom out and talk about protecting your entire portfolio. These rules are here to prevent a single market event from causing a domino effect across your account. I mean, think about it. If you're long on 3 different bank stocks and the whole banking sector takes a nosedive, your individual 1% risks suddenly fuse together into one big concentrated bet. You got to limit your trades and avoid that kind of correlation to keep your house of cards from collapsing. And that brings us to this crucial point. Your total combined risk across all of your open positions should never, ever go above a conservative ceiling. A really good rule of thumb is to keep that total exposure capped at 2 to 3% of your account. Any more than that, and you're just flying way too close to the sun. All right, now for the fail-safe switches. This next set of rules, think of them as your emergency brake. They're designed to literally take you out of the driver's seat when your judgment might be clouded, after a losing streak and that temptation for revenge trading starts to kick in. This is where those non-negotiable rules are so important. 3 losses in a row, you're done for the day. Close the laptop. Total losses hit your daily limit, you shut down the terminal, no questions asked. This isn't about quitting. It's a strategic retreat to protect your capital and your mental clarity for the next day. And look, if you hit a more significant drawdown, the protocol gets even more serious. You have to have the discipline to stop trading with real money completely. This isn't just a day off. This is a full stop to figure out what's gone wrong. Has the market changed? Have you started breaking your own rules? You don't risk another rupee until you have the answer.
So let's wrap all of this up by focusing on the huge transformation that happens when you truly adopt these rules as your own.
Because at the end of the day, this isn't just about math and formulas, it's about shifting your entire approach from emotional gambling to professional, systematic trading. A system takes your ego, your hope, and your fear out of the picture, and all that's left is disciplined execution. That is your edge. This is it. This is the question that separates the pros from the amateurs. And it's the question you should ask yourself before every single trade you take from this day forward, because your answer will ultimately decide your future in the markets.